Welcome back. Now, by August this year, Sirius Real Estate had acquired its 9th business park, and since then, it has strengthened its portfolio with the addition of at least 6 more. The group has spent over 340 million euros on its acquisition trail in the UK and Germany. Looking ahead in 2026, the group plans to seek more attractive investments in Germany. Well, the company's CEO Andrew Coombs joins us for greater perspective. Andrew, good to have you with us here on Business Day TV. I mean, you embarked on this extensive growth strategy, 9 business parks in 1 year. Take us through what you're looking at, because you're going on a shopping spree.
Hello, Ray, and thank you very much indeed for having me on today. Yes, we have invested 340 million in the period to September, end of September, our interim results, and another 30 million since then. So we plan to invest just over 450 million euros in this financial year to March 26. And, you know, Germany is a great place to invest at the moment. As your viewers probably know, the new government lifted the debt brake earlier this year, and the country is embarking on investing nearly €1 trillion in infrastructure and defence. And we believe that that will drive a very, very significant tailwind. Hence one of the reasons why we're investing so heavily within that geography.
Yeah, looking at Germany, I mean, the UK as well. Now, you've spoken about that geography, you've spoken about that government. But I've been watching you. It's Munich. It's all around Germany. There's got to be something else here. There's got to be the people you're associating with, the office parks you are next to.
Yeah, there is. And for example, if we look at the recent acquisition for 44 million in Munich, there is a company linked to defence there that specialises in night viewing technology and also in terms of research for lasers as well. And we think they're extremely well positioned. If we look at one of our acquisitions in Bedford in the UK, next to where Universal Studios are about to set up, you know, we think that that property has got really good fundamentals, and the fact that there is a supplier of component parts for ejector seats for the F-35 Eurofighter only really adds to the case.
Gosh. So you've really done your homework in this. You most certainly have. Some of these properties that you acquired, do you need to tear them down and build them up again? Or are they just dollar ready to go?
We don't like to tear them down, but we do like to do something with them. So we're not just an owner of real estate. Typically what we will do is we will probably asset manage about 75 to 80% of what we buy, but we like to find another 20% that I would say you can refurbish the inside of and change the use of the space rather than actually tear it down. That's why we're able to get such good returns in terms of the 30% return on investment that we get from the capital that we invest inside those buildings.
It's interesting you talk about defence, and I've seen NATO have found themselves a little bit wanting because the United States seems to be pulling out of Europe now, and NATO needs to build themselves. This could be a fantastic growth area for you.
We think so. We think we're about to see, in property terms, the beginning of a defence super cycle. We're seeing it already. We've seen Rheinmetall receive orders for 7.7 billion euros from the German government on defence. You know, we're seeing that that company trades on 50 times its forward earnings. You know, lots and lots of people outside of Germany say, you know, will the money actually be deployed? But what we're seeing on the ground is it's being deployed right now.
Yeah. Let's go to the UK, though. You spoke about a few things now. I think it's looking at Hartlebury trading estate in Worcestershire. What is going to be your expansion in the UK? What are you guys doing there as well? Because it's not just Germany.
Well, Hartlebury is really, really interesting. I mean, Hartlebury started its life in 1937 as a defence asset. It was an RAF maintenance station. It's a 171-acre site, which is enormous. Only 20% of that area is covered by buildings. So there's huge development opportunity going forward. But we were able to purchase the site from Schroders. We can see lots and lots of opportunities to invest capital at really, really good returns, because there are plenty of buildings that need modernising in terms of, you know, the inside of the buildings, and that modernisation enables us to lift rents accordingly, and we think that that gives some very, very good return profiles.
Yeah. Looking at your results, I think they came out around about the 17th of November. I couldn't help but thinking your profit was there, but do you need to slim down a little bit? Now, I know that you're expanding, so it seems a bit of a contradiction. But if you look at staff and you look at, I don't know, management and you look at those driving the business, do you need to slim down a little bit just to boost those profits a bit?
Well, what we are doing is we're improving our cost ratio on an annual basis. We've improved it by about 2% in the last 12 months, and we'll continue to do so. However, we are effectively scaled to be able to increase and grow. That's what we're all about. If we were to stand still, we would absolutely scale down our internal costs. But we look at over 1,000 properties a year in order to buy maybe 15 to 20 of them. And of course, you need an operation, in our case, 500 people in 150 locations, to have knowledge of those local markets and be able to do that well. And that's why we're able to get the returns that we get. But it is based on growing, and we are scaled for growth.
This is a beautiful business model, it really is. Right, UK, Germany, what's next? Because if like you're saying, you've got to carry on building, you can't stand still. What's next?
Well, we love the fact that, with the UK and Germany, we have two counter-cyclical markets, both economically and also in the property cycle, all the more so since Brexit. We've got a lot to do in the UK, and of course, Germany, being at the beginning of what we think is going to be a super cycle, there is an awful lot to be getting on with in those two geographies. And we remain dedicated to operating and knowing well what is going on in the local markets in those two geographies.
Andrew, you said the B word, Brexit. How did that affect you? I mean, we were one community, then we weren't.
Well, of course, when Brexit happened, we didn't have the UK business. We bought the UK business in 21.
Right. And
one of the things that we have noticed in our UK business is that because it's much more difficult now to bring stuff into the UK, without friction from Europe, a lot more things are being produced, put together, tested, distributed from within the UK. And to do that, what you typically need is industrial property. So bizarrely enough, Brexit has turned out to be one of the key drivers for our UK business.
Gosh, that's quite interesting. Now, South Africa, of course. I mean, you trade South Africa, you trade also on the London Stock Exchange as well. We saw you on the All Share. What about South Africa? We see people coming back to office space here as well. We see an economy that continues to rebuild itself. We see a president who said thank you for the G20. I mean, what's in it for you?
Well, look, we listed on the South African Stock Exchange back in 2014.
Yeah.
In that 10-year period, shareholders have seen over a 30% return on their investment, provided they reinvested their dividend. We are very mindful of the fact if it wasn't for the South African markets and South African shareholders, 10 years ago, Sirius probably wouldn't be here today.
Yeah.
So I'm delighted that South Africans have seen such a good return from their investment in Sirius. And we are very proud of our South African heritage. I'm delighted to be down here this week in Johannesburg and Cape Town, talking to media channels and also shareholders. And we look forward to, a long relationship with the markets in South Africa.
I want to push you a little bit further, though. Development in South Africa.
The thing about development in South Africa is the metrics are, so fundamentally different. And what we would have to do in Germany and UK is we would have to manage exchange rate risk. We would have to manage the difference in inflation, the different returns that requires. And, it remains to be seen whether there's a time in the future, whether that becomes sort of stable and manageable enough. I'm not sure we're there just at this point in time.
But things have changed a little bit. They're looking a little bit better. After COVID-19, we've had this uptick. We've seen the global economy starting to grow now as well. They came through at the G20. Obviously, South Africa's got to sort of catch that. But globally, you must be smiling at Europe because there's a whole market right there.
Germany in particular. We think that Germany will again be the powerhouse. The difference is we think it will also be the backbone of European defence. Germany in particular we see as a very special opportunity within the whole of the European Union.
Yeah. Andrew, what keeps you up at night?
Lots of things.
Yeah.
People used to ask me that years ago before we had the tensions with Ukraine. And one of the things I used to say is, the end of the Merkel era would bring about a great deal a great deal of change. At the moment, one of the things that's keeping me up at night is what happens politically in the UK. Okay. Fortunately, that's only 25% of our business. 70% plus of our revenues are in Germany. But at the moment, trying to work out how the politics there are going to affect the economics of that market that we operate in is something that's really concentrating my thoughts.
Yeah, Andrew, thank you so much. Good to have you with us on Business Lunch. Good to also meet you in person as well. Thank you so much.
Thanks, Ray.
That was Andrew Coombs, CEO of Sirius Real Estate.